To my far right is Charlie Graham, who is a principal and founder of Europa Capital, which is an affiliate of the Japanese giant Mitsubishi estate. To his left is Goodwin Gaw, who's a founder and principal of Gaw Capital, and one of the people that we wish would stop working quite so hard and competing with us, particularly out of Asia. And then to my immediate right is Jack Chandler, who's the chairman of real estate at BlackRock, and having spent most of his career at LaSalle. I think the truth is the reason I'm at LaSalle is because he left, and we'll let you decide at the end whether that was a good trade or not. Now, in the greater context of things here, Goodwin is the one who's the lucky one of this panel, because I actually don't know him that well. So I can't say things to embarrass him in quite the same way I can the others. Charlie I know really quite well, and if we get him really going, we'll have him talk about his choice of hair color over the last several months, which has nothing to do with age. And Jack I actually don't know that well either, but given the amount of time he spent at LaSalle, I have some really good stories which I can use if I need them. All right, let's get a little more serious. We thought we'd start, and we're really going to focus on just a few topics because there's too much ground to cover otherwise. So we'll do our best to cover those topics, and then we'll ask for questions at the end. I think the first topic has to be, given the environment we're in, how is the real estate industry today competing for capital against other types of industries and asset classes? And from that perspective, of course, there's been a lot of capital raising in the real estate investment management industry. It's improved dramatically, although it's still concentrated in the hands of a few. And if you look at transactional volumes, and the trouble with having Lynn Thurber as my chairman twice is that she's using a lot of LaSalle slides. But the total transaction volumes in the fourth quarter of last year globally were the highest in the last 10 years. And for those of you who struggle to count, 2007 was within the last 10 years. So what are the implications of that? So I guess the question has to be, how are we competing for capital today? And I'm going to start with Jack and ask him to tell us how you think, because you see in Citi and BlackRock, the real estate group competing with lots of other groups. How's it working?
Yeah, and in fact, we have some clients who come to us who ask us to try to figure out sort of how alternative asset classes are comparing with each other. And I think there's a lot of sort of polite and slightly impolite cliches you can use to sort of describe the world. I think, as I get together with my partners in the other alts categories, a few things are true everywhere. It's a much better time to be a seller than a buyer. People are struggling to put new money out with valuations. Nobody's business models, no pension funds, no insurance companies' business models work with the debt markets where they are. So a lot of big investors are trying to flee from fixed income. You've seen a big movement in that asset class into what they call unconstrained fixed income, which I think is probably code for saying, please, we don't want to buy any more treasuries or gilts. Isn't there something we can buy where we can get our money back? And the answer is maybe. And I think the investors have been whipsawed by equities. So the holy grail is non-diversified, non-correlated income, sort of growing and stable income where you can get your NAV back. And so I think that, John, as you said with your statistics, there's an awful lot of money I think there's as much money fleeing other things as actually coming to real estate. But I think a lot of the capital views real estate as sort of the least bad among a sort of a not particularly attractive set of opportunities right now.
So to summarize quickly, although there's a lot of capital flowing in, there are no signs that capital flow is going to slow down.
You know what? I would actually say we think it's going to speed up. We think it's going to accelerate. I think everybody knows that quantitative easement is great for financial assets. investors sort of saw what it did on the other side of the pond and have figured out that the same thing's going to happen on this side of the pond, even without growth. So I think, for those who are investing, I think the bad news is it's going to get worse. The good news is there's lots of money. The bad news is everybody else, there's going to be a lot more money competing with you.
Goodwin, probably the biggest source of capital that people talk about coming into real estate is coming from Asia. Do you agree with Jack? Is that flow going to continue as it has been?
I actually think that Jack's right. It's just the beginning, right? I think the world, the problem is every central bank in the world is taking turns trying to do their own QE. With that, it's a money printing press, right? So the paper currency, in a way, in our view, is losing its value against certain asset class, which is why you see high liquidity gateway cities like London, Hong Kong, New York, and then to a secondary degree, Paris, Tokyo, Singapore. A few of those are just getting a lot of liquidity coming through. And for China point of view, everything in China is government-induced, government-led. So the government is actually trying to let some of the liquidity out of the country. And it's very obvious in what they are now allowing the institutional investors in China, as well as some of the private companies, to deploy the capital overseas. And they're going to make it easier. So it's part of the effort to, one, make renminbi more of a international currency, and secondly, to relieve some of the liquidity being flooded inside China, partly due to the QE in China also. So there's a lot of liquidity, and it's just starting to come. Obviously, some of those will likely make mistakes along the way, but many of those institutional money is also looking for the right partners in terms of executing strategy and putting the capital to work on their behalf.
But Charlie, again, trying to interpret what Jack said, it sounds like real estate is faring well relative to bonds and equities. But if you look at real estate pricing, I'll make it a global comment, but please make it more local if you'd like. Real estate pricing relative to historic standards, whether it's cap rates or prices per square foot, looks like it's getting to be reasonably richly priced. How do you look at that?
Well, first of all, I should thank everybody for staying, because John Zehner after lunch generally doesn't command such a wonderful audience. But,
all right, I'm going to tell the hair color story. Watch out. Watch out.
Yes, I mean, I think
It's not that he has hair. That's what
It's going to make that comment.
there's pressure on both sides. I mean, in terms of the capital being raised, the amount of dry powder, as they call it, they say globally is $217 billion. That's a very large amount of pressure just coming into funds, let alone the large institutions who haven't really started to come out of China and other places. So the amount of capital chasing assets, is putting pressure on prices. And the question is, we've discussed it in looking at the macroeconomic aspects of it, but I think it comes down to, we traditionally look at a yield being fairly rich in the City of London, 4.5% for an office building, but actually, why is it overpriced? If there's that much capital and people are interested in the asset class, there's no reason why it shouldn't come down beyond that, particularly where, on a global basis, if you're looking at Singapore or other places, you may find a lower yield is satisfactory. So I think the difficulty is to match expectations. If you look at some of the institutions still chasing overall, I was looking at one American pension fund with a target of 12% annual return for their real estate, including the majority of that in core. I think we've seen...
So you told them you could do that?
Of course. Which I was going to get on to why this selection of managers was so important. But I think that's managing people's expectations in a market, as you say, which is constrained, is really quite difficult.
Are those expectations being managed, Jack? Are the investors understanding what's really achievable today and adjusting their return targets?
So, there's a difference between hearing and understanding. So to support the answer of no, if you look at the actuarial assumptions of all the big pension funds, they're either unchanged or they're down, 75 basis points. So that's a pretty clear no. If you think about core real estate of being in the middle on a risk-return basis between equities and fixed income, if you assume fixed income's 2, That might be optimistic in some countries. And equity is 7 or 8, maybe. You know, if real estate was 5-ish, it's probably, you know, it's probably in the appropriate place relative to the other asset classes. And I think that's one of the reasons it's attracting so much capital. I think the unanswered question is, can any of these enterprises meet their business needs, support their business models with those returns? And I think that's a much different and much trickier answer.
Goodwin, at least my perception is that some of the Asians, and I'm really thinking the Koreans, are adjusting their return hurdles. Is that consistent with what you're seeing?
Yeah, absolutely. We have done quite a bit of the Korean outflow into U.S. and then subsequently U.K. They have. The last 2 or 3 years, obviously their own cost of funds have gone down, and they're seeing the opportunities out there, and they are actually reducing. A lot of the early Chinese haven't. Right, so from mainland China, you do have 2 camps. You do have the entrepreneurs, the private companies that actually are investing for much more different reasons. Right, institutions are basically deploying capital for slightly higher yield, better spread between yield versus cost of debt in these overseas markets as compared to China, which is a negative arbitrage in China. Right, but a lot of the developers actually, many of the press think they are dumb. They're actually not that dumb, because they may be buying large tracts of land in cities like New York or Los Angeles or London, but they're actually building these products largely for people from China, looking to diversify their own private wealth of having flats in these key cities. So they're building products that culturally are exactly what those guys want, and sometimes bypassing currency issues because they can sign contracts inside China to sell these guys units outside China directly to them, inside China with no language barrier.
I want to come back to the debt point a little bit. We just did a major office acquisition in Tokyo, several $100 million worth of debt. Care to guess what the all-in debt cost was, 5-year fixed?
85 bips.
You know too much. That was really good. Yes, exactly. 90 basis points. That's no fun. I struggle to get my mind around this, but it makes.
You overpaid, by the way.
Yeah.
Exactly. You should be 70.
Were you the seller? No, you were the seller. Hold on. But it makes cash yields that look otherwise awfully skinny pretty attractive on a cash on equity calculation when the debt cost is that low.
I mean, even UK, right? The swaps, 5-year swaps are 100 bips down versus 6 months ago.
I know. It's amazing. Okay, let's turn the focus a little bit to Europe. We are sitting in Europe, and Europe recently has been a bundle of good news. So we've got rogue central banks, and the Swiss central bank, and the ECB with their quantitative easing. We've got the risk of deflation. We have a banking sector that is probably considered the weakest banking sector in the world today still. We have Greece making an awful lot of noises about where they stand and electing a leadership that might very well come out of the euro. We have a small war in Russia, between Russia and the Ukraine. We have no economic growth, and we have an upbit of terrorism. So it seems wonderful. But why does anybody want to invest in a Europe that looks like that? They clearly are, but what's going on, Charlie?
Well, I love the Americans because they're always counter-cyclical. I was just talking to our Russian friend after the panel this morning, and he said the great thing about Russia, when it's really down on its knees and everybody's looking at it as being a basket case, people come in and say this must be a buying opportunity. And I think if you look at the amount of capital, the 62 billion raised for European real estate over the last 2 years, half of it outside, from managers outside of Europe. So I think that people take a global look, they look and see the opportunity. I think the difference between now and 2 years ago was obviously that asset prices have raised. And maybe the question is, have they got too far in is the risk that was sort of downplayed over the last 2 years with the undertaking to do what it takes to support the currency, etc., are we starting to see a lot of nervousness? I think that fundamentally the view is that Europe is there, that the currency will remain strong, or not as strong as it has been, but certainly
intact.
The Brexit will not necessarily cause the catastrophe that we've had before. But I think there is more risk and there's more concern, and it'll be interesting to see whether the flow of capital continues at the same rate as it has over the last 2 years in, of course, the next 12 to 24 months. So I suspect there's more concern.
But I think it's not just the Americans. At least my perception is that many real estate investors look at a United States that is fully priced, hard to find bargains. Same thing is true in Asia. And at least their perception is that there are still, I'm not sure bargain's the right word, but better opportunities in Europe, notwithstanding those issues. Goodwin, do you agree with that, where you sit?
I mean, I think real estate, right, one is fundamental, two is these days, because of so much money being sloshed around the world, it's also capital flow. And the world is more and more connected these days, and it's becoming a bigger connected market in a way. So as an investor, if you have patient enough money or you have money long-term enough to ride the cycles, you actually can also make money just by the fact that if you're a step or two ahead of the capital flow, when the capital is going to come back. And I think Europe, by nature, because it's so cheap, I mean, many countries in Europe these days, you look at the property prices, they are cheaper than the tier 3 cities in China, honestly. Obviously, the population is also smaller than the tier 3 cities in China. Right. But obviously, the disposable income, median income is all higher. Europe has its own problem, but it just, on a relative basis, it's cheap. So that's why it's attracting a lot of attention.
Well, we'll come back and talk about any challenges in China, but we'll save that for later in the conversation. We are in France, having flown in yesterday into Orly, which is an airport that is in drastic need of refurbishment. But I arrived safely, so it was fine. But people still are investing in real estate in Paris in droves. What's driving that, and what's your view of the real estate investment markets in Paris, which arguably is lacking economic growth in the whole country, has an infrastructure that's crumbling? The United States does too, just by the way. And no real rental rate growth that I'm seeing in Paris. Jack, why are people still so interested in Paris?
Well, listen, I think Goodwin articulated sort of the strata. Global investors are looking for sort of gateway cities, and Paris is still very much on people's shopping list. I think second is investors view QE as sort of a, you've taken the left-hand tail risk off the table, because the banks have basically said they're going to keep printing. They're going to keep printing unless and until it gets better. So I think people feel like, you got some downside protection. They've seen QE sort of inflate asset prices elsewhere. The euro is a lot less expensive now than it was six to 12 months ago. So I think I think people are looking at Paris in many ways similar to Tokyo, and Goodwin might have a view. There's not a lot of growth. It's a big market. It's sort of an inefficient market. You've got a lot of. I heard a fascinating statistic yesterday that of the 8% of office vacancy in Paris, half of that has been vacant for 3 years. So you have people, and you can't convert to resi, and there's all sorts of structural impediments. So I think investors, we look at that and think, well, that's kind of an illiquid, slightly illogical, chunky market. Demand seems stable. Rents are probably stable. If you can get into assets and sort of go through the manufacturing process, you can probably do okay. And your risk of a major sort of negative dislocation on the fundamentals is probably not that great. You sort of count on Paris kind of sort of knocking along sideways. So, all in all, it doesn't actually seem that bad.
Charlie, are you investing in France? And maybe I'll broaden the question. Where do you see the investment opportunities in Europe today? And you'll correct me if I'm wrong, but most of your capital is opportunistic.
Yes, most of it's opportunistic, although we are also focusing on UK debt, mezzanine debt, as it happens. But we try to cover as much of Europe as we can. I think that's what people expect us to do. Having said that, there are, again, some investors who say, well, if you think the UK is the best place, put it all there. But we do try to spread out. We find it difficult to invest in France. We have made one or two investments. I think that I think there's always been a tendency to see volatility in rental rates. I remember after 2000, 2001, we'd invested quite a lot of capital into France from 99, and we thought that yields had compressed and that rents had risen to, were starting to fall. And so we exited at that time. We thought people were crazy. With rental rates on their way down, why would be people pouring the capital in? But of course, they kept compressing, and people who invested at that time made a lot of money on the yield compression. So I don't think you can always follow the rent in order to be able to suggest the time to come in. The answer is yes, we will put money into France, and we have done. We found Germany quite competitive at the moment. There are assets that people are buying, in our view, that are difficult things as far as you're talking about the ability to release space when the tenancy comes to an end. Will we be able to keep the tenant? How much we have to spend to do that, etc. But I think there are quite a lot of interesting opportunities coming where portfolios have been starved of capital because they're in structures that don't permit capital expenditure. And so I think the interesting opportunity for people like us is to find those situations where capital has been starved and where you've got the discretion to go in and spend money. In fact, we've done that here as well. Central Europe, the difficulty we have there is that generally speaking, the markets aren't big enough. But for instance, Hungary at the moment has come back. We felt that Hungary was mispriced relative to some of the other Central European countries. People didn't particularly like the government approach, and particularly the relationships with the EU, and we think that people have got over that at the moment, and Hungary is actually improving a little bit. But probably we put 40% of the capital we raise into the UK.
Well, the country that's been spoken about as the great place to invest for the last few years has been Spain. Goodwin, do you have a view on Spain, and is it really such a great place to invest?
I've only been there as a tourist, so I obviously like the culture, like the food, but honestly don't really know enough about it. By the time we started looking at a lot of the retail opportunities there, I think it's late. I think we're probably at least from Asia, and I think that view is shared among a lot of the Hong Kong investors, Singapore investors, mainland China investor. They feel Spain was the pick, but it's probably 2 to 3 years late.
Yeah, I agree with that. Either of you two investing in Spain in a major way right now?
We haven't. We've been, I think as Goodwin said, in a market like that, there'll be a few good trades, but we haven't been that confident with the underlying economy, and, maybe haven't had a view that we could be just sort of do the market timing to make money. I think, like as Charles said, I think we're a lot more confident investing where we've got some control of the asset and can inject capital and sort of, in many ways, sort of get an asset back to where it should be in terms of the competitive set.
Yeah, we're, I think, focused on. We haven't been big investors in Spain, but we made one very large investment on a bet with a sale and leaseback portfolio with a couple of partners with BBVA. And exited that this year. So that could have been a signal that, that it was time to get out. But actually, we've gone back into the residential side in Barcelona. We think Barcelona is a really interesting city. It's got a lot of what Goodwin was saying in terms of, I think for foreigners, particularly, not only Europeans, but from Asia and other places, it's got a lot of what it takes. It's got a decent airport. It's got a reasonably good economy. It's a wonderful place to live in a great climate. And if you're looking at places to follow on the Mediterranean, Barcelona stacks up as far as we're concerned. So sort of slightly higher end residential in Barcelona we think is pretty interesting.
Let's turn the attention a little bit now to what are the sources of capital coming into Europe? Again, I think people talk most about Asian sovereign wealth funds and national pension funds, still Middle Eastern money. Goodwin, how would you describe the current flows from those markets into Europe? And I've got some comments, particularly on the Middle Eastern side.
I think you see the bulk of that going to UK for a very simple reason: tax. Right? Tax is easy, efficient. They welcome foreign investments, especially as compared to US and New York, right? FIRPTA and all that. So, and it's really three pools. You got the high net worth individuals from China who are actually looking to buy apartments. And those guys will buy flats in London, buy houses in London, and they are actually now you're seeing a lot of them buying house in Portugal, of all places. But obviously, they're buying it because of visa, right? They're getting the visas. So you have a lot of the rising middle class, disposable income, trying to take the capital outside of China. You have that group buying flats in these gateway cities. And then you actually then have the private developers doing very, very large projects in these cities, building out the network, and also many of them selling these products back to the people in China. And some of them will be paid actually renminbi inside China. That's how it's going to be done. And then you actually, the first wave of the institutional investors are coming, right? So we've done a few fairly large trades in the UK for the big insurance companies in China. They're flooded with liquidity, they have a lot of liquidity, and they will, that capital will actually, I wouldn't be surprised if this year is 3 times or 4 times last year, and then the year after that it will be 10 times, 15 times. It's just beginning. So all that will come, and you just have to figure out where that capital is going to go, and if you're a little bit, a step or two ahead of them, it's going to, the flood of that liquidity will actually drive up prices in certain cities.
Again, I want to come back to China at the end of this. Jack, do you have a view of where the capital sources are that's coming into Europe?
Yeah, I think the thing, Goodwin, the things you're talking about get a lot of headlines. But I think, as you would know from your work, that, most of these markets are still domestic markets. The vast majority of capital in the UK comes from the UK institutions, same with Germany, same with France. So those are still the foundations of these markets. The North Americans have sort of had the big institutional investors have had a really nice run in the US. That's starting to slow down. They hear quantitative easing, they hear distressed, whatever that actually might mean. So I think you're going to see more and more money coming from the US and Canada. And I think the reality is that when you talk about gateway cities, you have a couple of the key destination markets, Paris and London here. And everybody who's starting a global real estate direct investment program shopping list, they're all the same shopping lists. And so they're going to want something in Paris, they're going to want something in London.
I think it's a good point. There's certainly still a lot of domestic capital from the UK, Germany, certainly. One of the things that we're beginning to see is French capital and Italian capital actually interested in getting outside of those countries, which historically, at least my perception is, hasn't been true. But maybe with the economic challenges of France and Italy, they're realizing that they need to diversify. At least we're also seeing some impact in the Middle East on the decline in oil price. And some of the sovereign wealth funds still have money, others do not. And it's changing the power there in terms of investment appetite. In terms of Europe, where are the greatest opportunities? Core, opportunistic? Charlie?
Well, I think there are opportunistic, and I think there are some interesting areas. We've been, whether you've got the ability to do it, we were talking in yesterday's council meetings about the lack of modern space because so little has been built since the recession. So I think that if you can get your head around it, development in a number of German, even UK, but continental markets will be quite an interesting play. The difficulty for an opportunity fund is if you can't get any financing, the margins to which German developers, and probably some in the room, are used to developing to are pretty skinny compared to what the American tradition was, or at least what I tried to do when I lived out there. And I think that what we've got to do is to see whether or not debt finance will come back into selective development activity, because there I think is going to be quite interesting. Doesn't answer your question particularly, but I think there are opportunistic plays. We talked about a number of others with maturing funds and that sort of thing. So notwithstanding the huge amount of dry powder, I think there are opportunities in the opportunistic side. Maybe the returns aren't quite what they were traditionally, and maybe that's again discussion that needs to be had with investors. The core side, I think that any decent asset in any decent city will continue to trade and be very liquid. So other opportunities, I'm not sure there are opportunities to buy, but I think that those assets will trade, and I think they'll continue to get more expensive unless we have a major catastrophe in the European currency.
So you're able to, in your opportunistic returns, get to that U.S. pension fund's 12% return hurdle?
We hope to do much better than that, of course. But but actually, it'd be interesting to see how. You know, when you're talking about the Middle East, I sometimes find that I've just come into a room and the seat is still warm from where you've been there, John, but I haven't been in the Middle East for the last couple of months really to test that, and it'll be interesting to see whether the Middle East is as active as it has been in the past. I suspect that the American pension funds still have an allocation and still see opportunity. Both, I don't think they're going to come for core. What I think one interesting thing is that most of the major, I think they say 2/3 of the institutions with more than 10 billion of assets under management are really looking beyond funds into joint ventures and separate account relationships. And I think that's interesting, and we've heard a few of those. Oxford was one of them, used to go into funds at the beginning and is now a fully fledged investor in Europe and just as happy to do that. So I think we're going to see a bifurcation. One of the questions I had for you is in talking to the life companies in China, where they've got the ability now to invest outside of China, you would have thought that they would find it very difficult to go out and make the core asset purchases without, of course, they've got assistance of agents, etc. But you would have thought that they would be the prime targets for funds because they would get the exposure, the access, all of the things that they don't necessarily have at this point in time. I've been surprised that it's been reasonably slow in coming, and secondly, that the assets that have been bought tend to be iconic assets, Lloyd's of London. I mean, not what you would have thought was the most sort of easy asset for them to have bought. And I wonder whether you think there's a trend in terms of the capital starting to flow from the life companies and institutions through funds.
So it's interesting you mentioned Lloyd's, right? That was our deal. So we're the general partner in that deal.
Yeah.
I thought it was an easy deal. Single
Easy deal to do?
Easiest deal to understand, easiest deal to do, right? Iconic asset, Lloyd's Insurance headquarters, now owned by the largest insurance company in China. So highly iconic, both in the sense of patriotism and also economics. Richard Rogers designed building. So, and that actually was a deal that opened the channel. No insurance company in China has ever done a deal overseas at that point in time. So when we actually made that deal happen, I actually had to go spend time with the insurance regulator in Beijing to help sell that deal, to get the government to approve that deal for insurance company to start buying assets overseas. The question why you're not seeing them doing funds, it's just not a very cultural thing for China. They don't like to not have control. Even though, but once you are an insider, once you have start doing a few deals for them, once you have earned the trust, actually, virtually every idea you bring up to them, they will do. They tend to do, because it's a trust issue. It's very much an Asian thing. It's relationship, it's trust. And fortunately for us, it's a pretty high barrier to entry, because many of these insurance companies or large organizations are very hierarchy. So you got very senior management, chairman level, where someone on my side at the same level have to deal with, and then down to the working level. If you don't have every single level covered on a daily basis by different level of your teams, a deal won't get done. That's why you see so few transactions being done despite all the capital trying to come.
Interesting.
Well, let's segue, thank you for that, Charlie, into a discussion of China. China has obviously been economic engine of the world for many years now. But if I have my statistics right, its economic growth last year was the lowest in 24 years. That sounds terrible, but it was 7.4%, which sounds a lot less terrible. But there seem to be some tremors in the shadow banking world. First Chinese developer to default, Kaisa, just when, last couple weeks. What's going on? Will China continue to be an economic driver for the world at attracting capital? And will it also be an exporter of capital the way it has been more recently? How should we think about it? And I'm going to start with you, Goodwin, but then I'm really interested in knowing if Jack's got the same view.
One thing I agree with Jack on this one. I think the exporter of capital is overblown. If you look at the actual numbers of the amount of equity being sent in the US and Europe and all that, it's actually small relative to the Middle East. Russia's gone for the time being. But compared to US and traditional capital, it's still a much smaller amount. Problem with China, which I think we like to keep it that way, it's very difficult to understand for foreigner. And so Henry and I, we like to keep it this way, right? The more difficult it is for foreigners to understand, the more opportunities there are. So it's not transparent. If you don't understand the system, you think they change the rules of the game all the time. They do, but it's for a very simple reason, right? They have a contract with the people about social stability. And the way of managing social stability is to make sure when the economy heats up too much, they put on the brakes. When the economy cools too fast, they put on the accelerator and stimulate. Obviously, it's a very big ship these days. And every time they step on the gas or step on the brake, it overcorrects one way or the other, which creates a lot of opportunities. But ultimately, I can't think of any other economy outside of the US that is completely self-contained, right? And one thing I think people don't appreciate enough is you look at how the Chinese government is now making the entrepreneurs, the movie stars, the celebrities of China, Jack Ma, Robin Lee, Pony Ma, because it's the same philosophy. When these rags to riches stories are percolated over the economy, give people hope. And all of a sudden, they're saying, okay, those real estate guys who actually got money the easy way, buying cheap farmland and making a lot of money in the real estate sector, taking advantage of the farmers, they didn't do anything the right way. It's not the China way. But the entrepreneurs, the future, they're generating globally competitive companies, and they will be given a different set of rules to play in China for them to get bigger and bigger and bigger and become competitive on a global stage. But all of that is actually putting a lot of optimism into students, young people's mindset. It's one interesting fact is, obviously I live in Hong Kong, and I saw the student protests in Hong Kong, which were all very angry about the student protests in Hong Kong because they're ignorant, they're naive, they have no idea, they're so lucky to live in Hong Kong, yet having the growth of China right on the border. Then you go to China, the Chinese government no longer care one bit about the Hong Kong student protests because it's no longer contagious. You go talk to young kids in China, they say, yeah, these Hong Kong kids are spoiled because we have it good, tomorrow is going to be better than today, look at Jack Ma, look at Pony Ma, I mean, a lot of things are going in the right direction. It's going to be short-term pain. Next 2 to 3 years, volatility, short-term pain, hence the opportunities, right?
Jack, do you have a view?
Yeah, I think we actually are one of the few companies that has a domestic asset management license in a venture in China, and I think Goodwin's right. It is breathtakingly complicated. And the Chinese government, I mean, it's quite clear that over the next decade is going to allow more and more money to come offshore, but they're going to do it in their way, sort of, and with their timing. So I don't think that the global real estate markets are going to be flooded with Chinese capital. I think it's going to continue to be sort of a slow and steady buildup. So I would tell you that in terms of investing in China, we've always found it incredibly difficult, frankly, not because of the cultural barriers, but because there's just been too much damn money floating around. And so a significant contraction in credit and some of the dislocations that are happening are actually giving for us the first real distress we've seen in a decade in China. So we think it's actually a really interesting time to be putting money in. But long term, in 10 years, there'll be 10 times as much money from China flowing out, both from people and from institutions. But it'll be a bumpy path, and the rules will change many times along the way, would be our view.
Okay, thank you. Look, we have 5 minutes left to try to get us back on some semblance of a schedule. We've tried to focus on just a few issues. There are many more things we could talk about, and I have more questions for these guys. Any questions from any of you?
Thank you. I know we all look at reversion to the mean when we think things are in bubble territory or whatever. Now, do you think that, do I need to repeat? No? All right. Do you think that we need to use reversion to the mean? Has QE distorted that? So we can't use that as one of our little sort of techniques that we use, thinking, well, it will eventually revert to the mean, but we can't do that now because of what's happened with QE?
Well, this is fundamentally a question of, is real estate pricing expensive relative to past real estate pricing, or is it inexpensive relative to other asset classes? I don't know. How are you guys looking at this?
I think QE extends. I mean, QE is the scale of government intervention in markets is extraordinary by historical perspectives. So you can't not acknowledge it. And I think the old adage, "Don't fight the Fed," is probably right. I mean, things will at some point. I think we all hope that this ends and we get back to much more of a private-led capital markets scenario. So I don't think. I mean, I think anyone who says this time it's different is kidding themselves. I think it might be but this could be. We could be in this scenario for an extended period of time.
And I agree with that. I was privileged enough to be at Davos 2 weeks ago, and my overriding conclusion, hearing all of the conversations, was just Jack's summary. Interest rates are going to be like this for a long time, which doesn't mean that there won't be reversion to the mean, but it might be more dramatic and further out. Yes, in the back.
Just to pick up on that point of interest rates being low for a long time and your 90 basis points in Japan, interest rates are at 100-year lows in round figures. The spread between borrowing costs and yields are at record highs. Cash-on-cash returns on equity, can be pushing double digits. Real estate is cheap. This is the chance of a lifetime. It may not seem like that, but QE is just getting going. Billions in equity are waiting to come into the market. Capital growth around the corner. We'll all look back on this as the golden time to buy. I don't know whether you agree.
Are you an agent, perchance?
I'm a seller.
We're no longer interested in your contact details then. Thank you for that.
Touche. Any response to that?
Listen, we promise not to talk our book up here, so.
I think you said that this was going to be a controversial panel, but Ross was the one who needed to fire it up a little bit, I think.
Yeah, exactly right. All right, so last question as we get off the stage. How much longer do we have before the downturn? And remember, Lynn Thurber shows all the LaSalle warning lights, and it's completely benign. But as you heard Hamid Moghadam say, when things feel too good, he gets nervous and he gets paranoid. So how much longer do we have? Goodwin?
I think one thing that keeps me up at night is you look at the history of humankind. Every 20, 30 years, there's always a world war that basically redistribute the wealth. Today, with all the QE, the world's 1% or 0.1% or 1% owns so much, and yet there's no inflation because of the globalization, cheap labor elsewhere supplying the goods. So there's no inflation in a traditional sense on how you can live and survive. But there's absolute inflation in the amount of wealth that the asset-owning class is inflating at a far higher clip than the middle class. That's going to be a big problem. And revolution, evolution, I mean, that's going to be the big problem.
Okay, that wasn't exactly the question I was trying to answer, but
I
agree it's a very important question.
Right.
All right,
so I don't know how long it's going to last.
Okay, fine.
So I think what Goodwin is saying is that something will happen that is not on
our radar
on the fancy chart. It'll be a war. It'll be a war over water. It'll be social unrest. Something we can't anticipate will cause a dislocation.
Okay, I agree with that. Charlie?
Well, I have to say I get nervous looking. If anybody buys the Sunday Times property section and looks at the number of new projects, all which seem to be costing between £1,800 and £2,000 a foot. And I wonder how many people are in the bracket to be able to buy apartments. So when you look at the actual ticket price, I mean, I don't believe necessarily that the tap will continue forever to be turned on from Singapore, Hong Kong, and other places. It may be, but I have to say, I get nervous on the top end of the UK residential market, but that's just a personal thing. I think that one needs to be focusing on the fundamentals and not looking to try and inflate the business plans too much. And if I was being residential, I think we much more, Eric's my partner here, I think we're sort of convinced that the lower end of the market, because there are still people who need to live in houses that haven't got enough houses. The funny thing about China, I took the train once from Shanghai to Beijing, and you just see so many buildings going up. I mean, for 3.5 hours or more, 4 hours it takes in a TGV type train, And then I realized it takes 3 years to get a planning permission for 150 houses in the UK. And this is a government that's meant to be supporting house building. I find it extraordinary, I mean, from that point of view. So there is still opportunity in some parts of the thing.
Right, but that's also another commentary, as Goodwin's, about the 1% or the 0.1 of 1%.
Yeah.
Okay, nobody answered the real estate cycle question, but okay.
So why don't you answer it?
So you have a bunch of economists up here. So what?
How long have we got, John?
We're done.
Okay.
So look, to conclude, anybody who's interested in hearing the Charlie Graham hair color story, please see me afterwards. But please join me in thanking these guys for spending the time with us. It was great.
Well done. It's good fun.